When it comes to money, it's all about how you think. Think of life insurance like this, okay? The efficiency spectrum of life insurance. That's what we're going to look at. On this side, the most efficient policy that we could have, a one pay policy. I put in a dollar, I have a dollar to use, and I have more than a dollar of death benefit. Okay. On this other side, the least efficient, again, this is the most, this is the least. On the least efficient side is term insurance. I put in a dollar and I have $0 of cash value and I got a ton of death benefit. In fact, the only benefit that I have is death benefit. And it doesn't matter if I put a dollar or $1,000,000 in there, I still have $0 of cash value. So it's all cost, it's all insurance costs. Now, if I have a ton of death benefit, then how do I win with term insurance? Well, you sign the application, you give the agent a check, and you go outside and get hit by a truck. You got to die. It's a tough way to win. And the fact that the insurance company would give you the term insurance means that your chances of dying are very slim for the period that they're going to insure you. Now, that's how term insurance works. You only have one benefit, and less than 1% of term policies ever pay a benefit. And they're actuarially calculated. When you buy term insurance, are you betting with or against the insurance company? You're betting against them. And they have actuarial science on their side. So you're going to lose more than likely. You could be that one really fortunate person that gets the cash, the check. Oh, actually, you don't. Your family does because you're dead. Okay. Now, enough on term insurance. Let's just look at the cash spectrum of efficiency, the efficiency spectrum of an insurance contract from a cash value standpoint. Remember, I said a one pay policy was the most efficient because if I put in a dollar and I could take out a dollar or use a dollar, how much does it cost me? Nothing. All right. By the way, whole life, variable universal life, index universal life, all those different types of insurance are somewhere in the middle. But in 1988, the government said this one pay policy, that's not life insurance. There's nothing at risk. And they created this line called a modified endowment contract line, or MEC. Now, if you cross that line, meaning you get too efficient for your dollar going in the beginning, then it acts like a qualified plan and everything's taxable. Now, if you haven't seen our video on qualified plans, do yourself a favor, go back and watch that video. It'll make total sense to you. I'm going to ask you three simple questions, and you're going to know the answers to those questions. And then you can decide if a qualified plan is a good idea or not. But I don't want my money, especially my insurance contract, to act like a qualified plan. So what I want to do is I want to get as close to that line, that MEC line, as possible and have the maximum of cash, the lowest death benefit possible. Now, how do I do that? Well, I combine this whole life policy and a paid up additions rider. Okay. Now, I combine those two so that I can get my efficiency from here to right to that line without crossing it. Now, typically, without using an expensive term rider, which is dangerous because it can cause policies to MEC if you try to convert them, okay, without doing that, it's somewhere in this range, okay? About 60% can go into the paid up additions. Okay, so let's take a $40,000 premium, which is one of the examples that Nelson uses in his book, Becoming Your Own Banker. Now, about $24,000 is 60% of 40,000, right? So every year I'm putting in 24,000 and I have $24,000 of cash. Looks pretty good. Now, 40% of this premium goes into the base whole life policy. And I'm going to show you why Susie Orman and Dave Ramsey and those financial entertainers, why they don't like whole life insurance. Because the first year I put in $16,000, I might have $2,000 or less. The second year, I'm going to have really close to my full amount, the full premium. So I have a cash drag in this first year. Now I'm even. Okay. So by the way, if I put $40,000 in the second year and my cash value goes up by $40,000, how much did I lose by putting that $40,000 in that second year? Zero. So my cost is zero. There is no cash drag. The next year, it's really close to 16 again. The third year, it's a little bit better than 16. Now we're starting to what? Leverage. The the fifth year, it's going, let's say I put in $16,000, it might go up 20. Now, if I can put in $16,000 and it leverages and goes, and I have 20 to use, then why would I want to keep putting money in this paid up additions? I wouldn't. So I would drop that off the policy, just as Nelson did in his example on equipment financing. And if you haven't watched that video, watch that video. You'll love it, especially if you're a business owner, even if you're not a business owner. Now that these dollars over here are leveraging, it's going to start to make up that cash drag that I had in the very beginning. Now, remember something. These are our videos to teach you about infinite banking. We haven't even started banking yet. This is just how we're going to use the insurance contract, which is not the most important thing in infinite banking. Nelson said it perfectly. It's a process, not a product. All right. By the way, does that get better? Does it get worse as time goes on? Well, how about year 10? In the example that I just looked at, we would put in $16,000 and we'd have $27,000 to use. Now, let me ask you a question. If you wrote me a check for $16,000 today, and I turned around and wrote you one for $27,000, how many times today do you want to do that? That's the power of infinite banking. That's what we teach at Create Tailwind. And if you go to createtailwind.com and sign up for one of our 1-hour coaching sessions, you'll get to learn how to do this for free. And after an hour, you'll know whether this is something you want to learn more about or not. So go sign up for your coaching session today. I'm Jim Oliver. Thank you for spending a few minutes with me and learning a little bit about infinite banking.